Hello and welcome to an update on our US dollar bond strategy. I'm Nora Morgan, Investment Director for our US Fixed Income Fund range, and I'm delighted to be joined by Lead Portfolio Manager Rick Patel. Hello Rick.
Hi Nora.
So maybe starting with the current investment context, maybe you could talk to us a little bit about some of the themes and opportunities that you're seeing in this space and why investors should consider an allocation to US fixed income today.
So we're in a fairly unusual phase in the recent economic cycle whereby the yields on offer for US fixed income investors are above the potential growth rate of the US economy. The US economy grew very strongly after the pandemic because of the strong levels of fiscal support to all income cohorts of the consumer. That's starting to phase out. Intentions for discretionary spending going forward are likely to be substantially lower, and we see that in various surveys. That suggests that the growth rate over the next 3, 6, 9 months will be lower, and that will readjust downwards the levels of longer-term interest rates. So with the gap between current market interest rates and potential growth rates being large, we think that the appeal of the US fixed income strategy is fairly strong at the moment.
And with regard to your investment strategy, maybe you could talk to us a little bit around how you are navigating this market environment and the long-term benefits for investors considering investing in this strategy.
The strategy has an active style. We look for market dislocations from time to time across the different sub-asset classes of US fixed income that we invest in, whether that's US treasuries, inflation-linked bonds, investment-grade corporates, investment-grade banks, as well as high-yield and emerging markets. We're constantly looking for opportunities supported by our research team and supported by our trading desk. At the moment, we find attractive opportunities in a couple of those areas. First is in US Treasury bonds, and the second is in the financial securities of investment-grade companies, especially from high-quality financial securities.
And if we think about the current investment strategy, there was a lot of noise and headlines around the SVB fallout in recent months. How are you navigating this challenging market environment? And, for example, where are you seeing opportunities in this space?
The financial sector, in general terms, is a very broad sector that we are invested in and we're looking to invest further in. We look at the market breaking it down into different geographical regions. One of the issues with the US banking system is the very diversified nature of the banks. The European banking system, the Australian banking system, for example, are much more concentrated, whereby banks have a much more consolidated position and are less exposed to some of the idiosyncratic risks that were on show in the US regional banking system. Our exposure primarily is towards the larger national champion banks in those areas. Related to the fallout from the SVB situation has been the knock-on impact to other sectors such as real estate sector, both in the US and in Europe. We have a very light exposure to that sector, but we're looking for opportunities to build that further as we see valuations move to more attractive levels despite the higher levels of risks going forward.
And lastly, on the US Treasury bond market, are you seeing this as an opportunity to add duration at current levels, or is there, what's your thinking in that regard?
So when we think about the duration allocation, we're thinking about the market pricing relative to the expectations that we have for the path of economic growth in the US going forward. When we look at economic growth itself, we break that down into the 4 components that drive economic growth, such as consumption, business capex, fiscal spending, and net exports. And by taking each of those in turn, we find that the risks are generally skewed towards the downside, either for the consumer, for overall levels of business capex. The fiscal outlook looks quite concerning with regard to the spending cuts that need to come as a result of the debt ceiling debate, as well as the net export outlook, which is always a volatile part of the growth outlook. All 4 components generally we think will have risk skewed to the downside, which will lead to the market having to reassess the potential path for Fed funds going forward beyond the near-term hike possibility. So we think that valuations are attractive and provides investors with the opportunity to add duration here.
Thank you very much, Rick. And thanks to everyone for listening today. If you have any further questions about our US dollar bond strategy, please contact your local Fidelity representative. Thanks again for watching, and goodbye for now.